IAS 40 Investment Property Measurement. This is a summary of the main content of IAS 40. Accounting treatment comprises recognition, measurement, and disclosure. This presentation will focus on measurement. All investment property is initially measured at cost. Elements of cost include purchase price and costs directly attributable to getting the investment property to the location and condition necessary for its intended use. Paragraph 20 to 23 indicates items that are and items that are not included in cost. The measurement of cost is at the cash price equivalent at recognition date. Where payment is deferred beyond normal credit terms, the difference between the cash price equivalent and the total payment represents interest. Interest is recognized in profit or loss over the period of the credit. Where investment property is acquired in terms of an exchange transaction, the investment property must be measured at fair value. If no fair value can be determined, the investment property will be measured at the carrying amount of the non-monetary asset given up. Subsequent measurement. Under subsequent measurement, there is an accounting policy choice between the cost model and the fair value model. Whatever model is chosen has to be applied to all investment property of the company. This is different from IAS 16. Under IAS 16, you have a choice between the cost model and the revaluation model. Fair value model and revaluation model is not the same. Under IAS 16, you also make this choice and you apply the chosen model to a class of PPE. Under investment property, you always have to determine the fair value. When you apply the fair value model, that would be for measurement purposes. But when you apply the cost model, you also need the fair value of your investment property for disclosure purposes. How do you determine this fair value? With reference to IFRS 13, which is a new standard and not within the scope of FRK 201. Subsequent measurement fair value model. You measure all your investment property at fair value. Fair value is determined with reference to IFRS 13, but in FRK 201 it would usually be given in questions. Because under the fair value model you measure all your investment property annually at fair value, that would result in an annual fair value adjustment. This gain or loss from change in fair value is annually recognized in profit or loss, either as other income or other expenses. It is not recognized through other comprehensive income. When you apply the fair value model to investment property, that investment property will not be depreciated. For example, the fair value of investment property 31 December 2014 is 500,000 Rand. The fair value of this investment property on 31 December 2015 is 550,000 Rand. So your journal entry on 31 December 2015 will be a debit to investment property through SFP 50,000 and a credit fair value adjustment through profit or loss 50,000 Rand. Please note, you may not call this a revaluation surplus and take it through OCI. IAS 40 paragraph 50. In determining the carrying amount of investment property under the fair value model, an entity does not double count assets or liabilities that are recognized as separate assets or liabilities. For example, equipment such as lifts or air conditioning is often an integral part of a building and is generally included in the fair value of the investment property rather than recognized separately as PPE. If an office is leased on a furnished basis, the fair value of the office generally includes the fair value of the furniture. When furniture is included in the fair value of the investment property, an entity does not recognize that furniture as a separate asset. C. The fair value of investment property excludes prepaid or accrued operating lease income because those items are usually recognized as separate assets or liabilities. So IAS 40 paragraph 50 prevents overstatement of assets and liabilities by preventing double counting. Assets or liabilities recognized separately are not taken into account in determining the fair value of investment property's value, and vice versa. The 3 bullets indicates the specific examples highlighted in paragraph 50. Subsequent measurement, fair value model. You measure all your investment property at fair value, but what now if you cannot determine the fair value reliably? There is a rebuttable presumption that you are able to calculate fair value. Only in very rare instances will it not be possible, and that would include the situation where you have an inactive market or you cannot even apply alternative methods to determine fair value. When that is the case, so you are on the fair value model and all your investment property needs therefore be on the fair value model, and you need fair value for all those property. If there are now one of those property that you cannot determine the fair value, you may apply the cost model of IAS 16 to that property. Then the residual value must be 0, and you will apply IAS 16 until date of disposal. If you have investment property under construction and you cannot determine the fair value yet because the property is maybe not yet finished, so there's not a market for a half-finished constructed investment property, then you can measure it at cost until the construction is completed or fair value becomes measurable, whichever happens first. Subsequent measurement cost model. You measure all your investment property in terms of the cost model of IAS 16.